Hello everyone, hope you're all doing well and staying safe. My name is Abhinav Sekhri. I'm a chartered accountant and I cleared my CA final exams with All India rank 22 and I'm a faculty for CA final SFM. So I received requests from many students saying that they liked my videos and what I was teaching, but they weren't able to understand it completely since I was teaching in Hindi. So I've decided to upload this video in English so that everyone can catch on. Okay. So today we'll be doing a quick concept based revision of the chapter portfolio management. We'll discuss every single concept and try to understand and break down every point so that you can understand it easily. Obviously there are some parts where we have formulas, so we just have to learn them, but I can explain the concept behind using them, so that should help you. Okay. So let's go ahead. First of all, investment. Whenever we make an investment, we need to consider two things. One is return, the other is risk. We cannot focus on one and ignore the other. Focus needs to be on both of them. And obviously our goal is to earn maximum return at the minimum risk, obviously, right? And investment, whenever we need to make an investment, we can make an investment in a single asset or in multiple assets. Single asset is covered by the security analysis chapter and multiple assets are covered by the portfolio management chapter, which we are studying right now. Okay. So how do we calculate return of a stock? Return of a stock is calculated as capital appreciation during the year. Closing value minus opening value plus dividend income received during the year. The entire thing divided by the amount of initial investment. This will give you the return earned during the year. And this is done when we have past data. Past data, that is data related to the previous years. If we have future data, that is we have probabilities in the question. So what will we do? We'll calculate return as the sum total of expected return into respective probabilities. Like we'll have multiple returns given and multiple probabilities given. So we'll multiply each of them and the sum total of the column will be our return. Like we have x for return, p for probability, so the column will be px where we multiply all of them. So the sum total of the column px will be our return if future data is given. Okay. So return of an individual stock can be past data or future data. Past data, we'll calculate average return. Like for example, we have return for 3 years given as 8%, 9%, 10%. So we'll add all three and divide it by 3, 27 upon 3, that is 9% per annum will be our average return. So that's how we calculate summation x upon n. Simple arithmetic mean, you already know that. Okay. And in case of future data, we'll calculate expected return just like we calculated above, summation px. If we have a portfolio of stocks, we'll calculate weighted average return of individual securities. See, we learned how to calculate return of a single security. So we'll calculate the weighted average return of all the securities in the portfolio. Now weighted average, we need weights. What will be our weights? Weights will be the amount of investment in the security divided by the total investment. So for example, we have a portfolio of 10 lakhs and we have invested 2 lakhs in stock X. So our weight for stock X will be 2 lakh upon 10 lakh, that is 0.20. Okay. And second part, risk. See, we in the beginning we studied that we'll focus on two things, return and risk. We have understood return, now we'll understand risk. This is our base. We are building our base so that we can understand the concepts very nicely. Okay. And what is risk? It means volatility and not loss. Be very careful, people tend to make a mistake. Risk doesn't mean only loss, it means volatility, upside movement or downside movement. Okay. And it is measured as fluctuation or deviation around the mean. So for example, if we have a return of a mean of 10% and expected returns can be 8%, 10% or 12%. So this shows us that there's a deviation of 2%, that is risk of 2% involved. 2% can be downside, 2% can be upside. Okay. Measure of risk is variance, and since variance is in square terms, we use root of variance, that is standard deviation, denoted by sigma. So standard deviation is deviation from the arithmetic mean, x minus x bar. X bar is our mean, obviously. And how is it calculated? Sigma equal to given return minus average return divided by n, the entire thing, sorry, given return minus average return squared divided by n, sum total of this squared under root. What are we basically doing is, see, this entire thing is variance. Under root variance is standard deviation, so ignore the under root. What we have is x minus x bar divided by n, sum total of this. Like for example, we have deviation over the like we have data for 3 years. We'll calculate deviation for all the 3 years, square it, so that why do we square it? Because it can be negative, x minus x bar, 8, 10, 12. See, 10 is the median, so in case of 8 it will be negative, right? So it can be negative, so we'll square it and we'll divide it by the number of terms and under root, since we have to calculate standard deviation instead of variance. Okay. And in case of future data, what will we do is given return minus average return, entire thing squared, multiplied by the respective probability and sum total. See, we had summation px. Now we have summation p into x minus x bar, the entire thing squared. Okay, and under root, obviously, since this is variance and we are calculating standard deviation. Okay. So variance is denoted as sigma square equal to standard deviation squared, and high variance means high risk, obviously. And see, we have understood risk and return. Now we'll see what topics we have to cover in this chapter. First is modern portfolio theory, MPT, CAPM, capital asset pricing model, arbitrage pricing theory, efficient market hypothesis, portfolio rebalancing, Sharpe's optimization index. Out of this, these three are the most important. We'll cover all six, but these three are the most likely to be asked in the exams and are concept based. You need to understand what's happening. Okay, so let's begin with the first topic, modern portfolio theory or Markowitz portfolio theory. What does this say? It says that when you combine multiple assets in a portfolio, the overall risk gets reduced. You get the benefit of diversification. For example, you have X, Y, and Z three stocks. If you combine all of them, the overall risk will get reduced. So the risk of the portfolio will be less than the sum total of risk of X, Y, and Z. Why does that happen? That happens because of R, correlation. You must remember correlation. Correlation is a numerical value between -1 and 1. What does it mean? It means tendency of points to fall in a straight line. So a strong correlation will mean a higher probability that points will fall in a straight line. Straight line, what do we mean by that? It means that they will behave similarly to each other. If one tends to move up, other tends to move up. One tends to move down, other tends to move down. Okay. And see, so okay, so a correlation of 0.7 does not mean that if one moves by 1, then the other will move by 0.70. Don't confuse it with beta. Like a beta of 2 means that if the market moves by 1, the stock will move by 2. That is not true in case of correlation. Correlation of 0.7 means that there's, like for example, there's a 70% possibility that both the stocks are likely to move in a similar manner. It isn't a guarantee, it isn't an exact ratio, like if one will move by 10, other will move by 7. No, this is the likelihood of similar movement. Okay, and no two stocks have the perfect positive correlation. Why so? It is impossible. Why? Because see, if macro level factors are same, even then micro level factors will be different. Like each company has its own pros and cons, own strengths and weaknesses. So there cannot be two companies who have the exact same way of moving or reacting to the market. So no two stocks have perfect positive correlation. It will always be less than 1. Okay. So if R is equal to 1, risk equal to weighted average of standard deviation, like see, there is no benefit of diversification, like R equal to 1. So whatever random movements are there, both will go along go in their individual direction. So the risk of the portfolio will be the weighted average. There is no benefit of diversification. So if there is no benefit, risk of A plus risk of B into respective weights will be the weight of risk of the entire portfolio. There is no benefit, so simple weighted average will be done, right? This is how you should think. But R is less than 1. I told you no two stocks have perfect positive correlation. So it is less likely that they will move in the same direction with the same proportion. So when R is always less than 1, it means that risk of the portfolio will be less than the weighted average. See, if R equal to 1, that is the ratio is same, then we have weighted average, that is our risk. But R is always less than 1, so the risk will always be less than weighted average, and that is what we just said. Basically, MPT says that when you combine stocks in a portfolio, overall risk gets reduced, and that's what's happening. It would have the risk would have been weighted average of the standard deviation, but now it is less than the weighted average, and that's what I said. Remember, just a sec. I told you that risk of the portfolio will be less than the individual risks, obviously not sum total, weighted average. That's how we calculate risk and return. So the risk of the portfolio will be less than what it would have been had they been individually invested. Okay. And overall risk is reduced, hence proved. And how do we measure correlation? See, we've understood what R is, what is a positive correlation, what is a strong correlation, etc. etc. How do we calculate it? R is covariance of X and Y divided by sigma X, sigma Y. Now what is Sorry for the interruption. So we were discussing what is covariance. Covariance refers to the average of the joint deviation of x around x bar and y around y bar. X around x minus x bar, deviation, y minus y bar, deviation, joint deviation, that is the product, and sum total divided by n, average. So covariance is average of joint deviation of x around x bar and y around y bar. What is this? See, variance is with our own mean, x minus x bar, the entire thing squared. We calculate that sum total of that, right? That is our variance. What does it actually do? See, x minus x bar can be negative. That is why we square it, so that it is easier to calculate, right? And later on we calculate the square root of variance to get standard deviation. So variance is with our own mean, covariance is between two different stocks. X minus x bar, the whole square, can be written as x minus x bar into x minus x bar. That's what we are doing. But here we have two stocks, so we have x minus x bar into y minus y bar. In variance we have x minus x bar into x minus x bar, sum total, right? So this is the difference between variance and covariance. Covariance will always be in square terms, obviously. See, this is a percentage, this is a percentage, percentage into percentage will be percentage square, right? And in case of probability based data, we'll have the same thing. We had sum total of p into x minus x bar, the whole square, and here we have p into x minus x bar into y minus y bar, and sum total of that, right? And the answer here can be negative. Why? Since we aren't squaring it. Like while calculating variance, we know x minus x bar can be negative, so we square it so that negative term is wiped out. But here we aren't squaring it, so if x minus x bar is negative and y minus y bar is positive, when we multiply we'll get a negative figure. So this means that this answer can be negative, covariance can be negative, and since covariance can be negative, R can be negative. Standard deviation and standard deviation will always be a positive figure, right? Variance is a positive figure, standard deviation is a positive figure. R can be positive or negative. Why? Due to covariance, right? So now you're understanding things. We can always rote learn these formulas, but once you understand the logic, you'll be able to go through sums very easily, right? And therefore R can be negative, since we have learned this, that due to covariance R can be negative. And so variance is positive, since it is always squared. Standard deviation can be positive, R can be positive or negative. Okay, so the sum total can get reduced if stocks behave differently. Like when one is positive and the other is negative, this means that they will counter each other and will get a lower R. That is why we say that when stocks have a lower R, it tends to give us more protection. That is, we are protected from sharp movements in the portfolio, and our goal of risk reduction is achieved. Like, see, if we have two stocks who move exactly the same, in the same manner, in the same direction, then if one stock falls, the other will fall too, so we'll get a loss. But if we have two stocks, like when one moves forward, other moves backward, so we'll have a balanced portfolio. That is, no matter wherever market moves, we will have a fixed return, right? Fixed return or a basic return that does not go away. Like if we have the same two stocks with the same movement, we'll lose all our money, but here we won't. Here we will be secured, we'll be hedged. Like for example, 100 my foot, like, ignore the example, no sense, you've understood the thing, right? And the next thing is coefficient of variation. We calculated covariance above, okay, and now we have coefficient of variation. This is used for decision making, to evaluate and compare portfolios, and this refers to risk as a percentage of return. Like I earn 50% return, but for that I need to take 20% risk, so 20 upon 50, 0.40 is our coefficient of variation. Similarly, if I have another stock where I earn 40% return, but I need to take 30% risk, so 30 upon 40, 0.75 is my coefficient of variation. So 0.75, 0.4. 0.4 is the better one, since I am getting a greater return as compared to the other one. For the risk, for the amount of risk taken, we are calculating risk as a percentage of return. How much risk you need to take to earn the return? Standard deviation upon mean into 100, simple. So lower is better, obviously, very easy, right? So now we get to risk of a portfolio. Just like return is weighted average, risk is also weighted average, weights into standard deviation, okay? And of each stock, like weight of A into standard deviation of A, weight of B into standard deviation of B. Just like in case of return, we have weight of A into return of A plus weight of B into return of B, right? And since variance is in square terms, we get to weight of A squared, standard deviation square, weight of B squared, standard deviation of B squared, plus 2 into weight of A, weight of B, standard deviation A, standard deviation B into RAB, written in red since I want you to focus on it, right? And since we are calculating standard deviation, so therefore under root, right? And only the third term here can be negative. Why? Since r can be negative, right? And therefore lower r means greater risk reduction. See, we have discussed that the lower r is, the more risk gets reduced. But how does it happen? It happens here. See, look carefully. You have, this is square terms, this is square terms, and this is r. This third term is being added, third term. Okay, so the lower the r is, the lower will be this term. So that means the entire sum total will be reduced. For example, if we have r equal to 0.8, we'll get an amount. And if we have r equal to 0.2, we'll get a lower amount. And lower amount added means lower amount of risk, right? So this is why lower r means greater risk reduction. If let us suppose we have 0.8 and instead of that we have minus 0.8, that is amazing. This figure will become minus. So the risk will get reduced. Like this is 100, this is 100, and 200 minus the third figure. Instead of adding, we'll reduce it. So the grand total will get reduced and therefore overall risk gets reduced. This is how a lower R leads to a greater risk reduction, since it decreases our sum total and hence standard deviation falls. Okay. If R is equal to 1, for example, R is equal to 1, then there is no benefit of diversification. Why? If R is equal to 1, then what are we left with? We aren't left, this disappears. So we have a square plus b square plus 2ab, that is equal to a plus b the whole square, and under root of a plus b the whole square will be a plus b, that is weighted average. See, normally there is no benefit of diversification. We know that a plus b weighted average. Weighted average means there is no risk reduction. We are exactly where we should be. But if we have R, if we have a correlation, a stronger correlation, that is a lower R, that means the sum total will fall and we'll have a greater risk reduction. Okay. And where we have R equal to minus 1, we have maximum risk reduction. A square plus b square minus 2ab, that is a minus b the whole square. Under root of that will be a minus b. That is weight of A standard deviation of A minus weight of B standard deviation of B. See, this is amazing. Both of them are offsetting each other. Entirely reduced. Like earlier we had A square plus B square plus 2AB. Now A square minus B, A minus B. We have reached, like, if this is 100 and this is 100, this goes on to become 0. No risk. They tend to offset each other, right? So that is why R equal to minus 1 is perfect. It is known as a risk-free portfolio. So now we may have a question in the exam where the question asks you to construct a risk-free portfolio. What does risk-free portfolio construction mean? It means assigning weights to the individual stocks. Like you have a stock A and stock B and you're asked to construct a risk-free portfolio. R equal to minus 1. So you are required to assign weights, that how much weight should A hold, how much weight should B hold. Okay. Question will ask you to assign weights. Okay. How will we calculate this? Weight of A will be standard deviation of B upon standard deviation of both. Okay. See, we have to learn this. There's no logic or no shortcut. We'll get if we get such a simple question, we just need to put the formula and get marks. Okay. So standard deviation of B upon standard deviation of both. Like students might remember, Sanjay Saraf sir students might remember, दूसरे का risk upon दोनों का risk, something like that. Okay. See, ignore that. Weight of A will be calculated in this way and weight of B will be calculated as 1 minus weight of A. Okay. Very easy. This is what we obviously do. We calculate weight of one thing and deduct it from one to get the weight of the other, right? Normally such a portfolio is not possible since R equal to minus 1 is highly unlikely. Two stocks with a perfectly negative correlation is very, very unlikely. Possible but unlikely. R equal to 1 is impossible, it doesn't exist. But R equal to 1 does exist, but it is very unlikely that they move exactly in opposite directions, right? Therefore, since we know that R equal to minus 1 is highly unlikely, so risk-free portfolio is not possible generally. So MRP, minimum risk portfolio, comes into the picture. And derivation is irrelevant, so we have ignored it. There's no point in discussing the derivation. How do we construct a minimum risk portfolio? You can get a question like that. Okay. So minimum risk portfolio can be constructed as weight of A will be equal to variance of B minus covariance of both divided by variance of both minus 2 covariance. Variance of B minus covariance upon variance of both minus 2 covariance. Both 2 variance of B minus covariance. This is how you remember. Both and 2 are in the denominator, right? And both side covariance is being reduced from the variance. Okay. And we have some notes. First, weight can be negative, obviously, like it is like you have 80 and 20, 0.8, 0.2. This can be a weight, but you can also have weights as 0.2 and minus 1.2, something like that. This, sorry, what did I say? 0.2? No, ignore that. Kindly ignore that. Okay, weight can be negative. This means short selling, like minus 0.5 and 1.5. The sum total should be 1. What I said earlier was sum total was minus 1. That was wrong. Sum total should be 1. So you can have minus 0.5 of stock Y and 1.5 of stock X. How will this happen? You will short sell. You will sell stock Y and use that money to put into X. So X will become 1.5 times. So weight of X will be 1.5. Weight of Y will be minus 0.5. Sum total will always be 1. Okay. And data can be past or future. You need to visualize the headings. See, this question requires us to calculate variance, covariance, right? How do we reach this? Like, see, we'll have the figure given. X, we'll have to calculate X bar, and Y, we'll have to calculate Y bar. X minus X bar, Y minus Y bar. X minus X bar squared, Y minus Y bar squared. X minus X bar into Y minus Y bar. This will become our covariance. See, this is how we reach X minus X bar squared. Sum total of that will be our variance. This is how we do. See, I am not going to make you learn the headings. I want you to understand. See, we have understood the concept, what is happening behind each thing. And this was for past data. In case of future data, you will have P, X, Y, Px, Py, P into X minus X bar square, P into Y minus Y bar square, P into X minus X bar into Y minus Y bar. Covariance, remember the formula, right? So we aren't going to learn them, we are going to visualize them. Our concepts are clear, we'll be able to solve anything, right? Believe in yourself. All these questions were for two securities. In case we have three securities given, A, B and C. So we have two methods of solving the question. One is the simple squares method, like weight of A square, weight of B square, weight of C square, then 2AB, 2AC, 2BC, something like that. Okay. And R into RAB, RAC, RBC, individual R will be multiplied with the 2AB wala term. Okay. And in case of three securities, other option is variance covariance matrix. If you remember those type of questions, you should solve one of them, since the institute loves these questions a lot and tends to ask them. So do go through it. Variance covariance matrix, you'll have A, B, C, A, B, C. Then and then you'll have 9 figures, right, for a 3 by 3 matrix. And A into A will be variance of A into B will be covariance of AB, B into B will be variance of B, C into C will be variance of C, something like that. And the figures of AC and CA will be same. Obviously, variance of A with C will be covariance of A with C will be the same as covariance of C with A. If you have seen the sums, you'll understand what I'm saying. Otherwise, you'll think I'm behaving weirdly, but that's not the case. Okay. And the fourth point is standard deviation is average fluctuation around the mean. If standard deviation is 10, it means that on an average, the return will fluctuate plus or minus 10%. I told you standard deviation risk is plus and minus both. Okay. However, don't make a mistake. This is only the average, and actual figures may vary in any direction and up to any extent. What does this mean? This means that on an average, the stock return may increase by 10% or may decrease by 10%. But this is only the average. Actually, it may increase by 100, 200 or decrease by 100, right? Obviously, it cannot decrease by 200. 100 decrease by 100 will make it 0. So this is only the average, and actual figures may vary in any direction up to any extent. Okay. This finishes our first topic, MPT, Modern Portfolio Theory. Now we have CAPM, Capital Asset Pricing Model. I'm sure all of you love this. This is also known as Capital Market Theory. See, MPT focuses on risk. We have entire discussion on our risk. CAPM focuses on return. MPT says you need to invest in a portfolio to reduce risk. Like when we invest in a portfolio, overall risk gets reduced. That's what we learned in MPT. What does CAPM say? It says that invest in the best portfolio, that is market, Nifty or Sensex. Why? Because unsystematic risk of individual securities will get cancelled out. Only systematic risk will be left. See, we discussed what is risk. Risk has two components, systematic risk and unsystematic risk. Okay, let us understand what are those. First, systematic risk. This is also known as market risk or non-diversifiable risk. and it means risk due to the market or economy. It is a macro level factor common for all entities, like it affects all the entities in the industry, right? For example, interest rate risk. If interest rate changes in the market, that affects every single company. That is not specific to one company. Reliance, TCS, everyone will suffer if interest rates increase, right? Inflation affects everyone. Market risk, that is trend. Like if the entire market is rising, your share will tend to rise. If entire market is crashing, you cannot survive. Your share will crash too, right? So this is what is called systematic risk. Risk due to the market or economy. It is common to everyone. Everyone has to suffer that. That is why systematic risk will always be there. Okay. But unsystematic risk is it is also known as diversifiable risk, residual risk, or company specific risk. It is a micro level factor and it is specific to individual companies. For example, strike by employees. Strike by employees of Reliance will not affect companies of the Tata Group, right? Dependency of on key managerial persons. So, for example, if someone dies or someone retires or someone switches their job, then your company will be messed up, but other companies won't be affected because of that. Government restrictions, like you have a legal issue, a court case going on, or government restricts you from doing something, that is specific to your company and not the industry as a whole. Okay, so since systematic risk is what affects everyone in the industry, unsystematic risk is company specific risk. Okay, so when we invest in the market portfolio, that is Nifty or Sensex, unsystematic risk of individual securities will stop mattering and the only thing that matters will be systematic risk. Okay, systematic risk refers to the sensitivity of stock return to market return, beta. This is beta basically, like if market changes by a certain percentage, how much will our stock change by, right? So systematic risk is beta of x squared into sigma square m, that is variance of market. Beta of stock into variance of market. Just read it and think about it. What is this? What are we calculating? We are calculating systematic risk. That is how much economy wide factors affect our industry, our company. Okay, so beta of stock captures the relationship between the stock and the market, and variance of market reflects the risk of the market. So if the risk of the market is 10 and our beta is 0.5, so only 5% risk we have, that is systematic risk. Very easy to understand if you think about it. Second thing, this is systematic risk. What is the other part? The other part is unsystematic risk. It is denoted by error terms in the chart. Error terms means points that do not fall in the line. I'll show you a graph, you'll understand it better. So unsystematic risk is sigma square E. E refers to the error terms. So our total risk is sigma square X of stock X. Out of that, beta of x squared into variance of market is systematic risk. We have removed that component. So what is left? Those are the points falling on the line, beta relation. Okay, and what is left? Points not falling on the line. Those are captured through error term, sigma square E. Okay, total risk equal to systematic risk plus unsystematic risk, that is equal to sigma square x, variance of x, right? And your favorite formula, Capm, Re equal to Rf plus beta into Rm minus Rf. I'll explain the error terms thing in a chart later on when we study characteristic line. Okay, don't worry about that. And what do we have here? The basic relationship, Re, required rate of return, equal to Rf, risk-free return plus beta. Beta, we know what beta is, into Rm minus Rf, return from the market minus risk-free return. Okay. RF is risk-free return. What is risk-free return? Return from government bonds, treasury bills. Why risk-free? Since there is no counterparty default risk. Government is not going to default. So you'll always have this return. Like for example, RF is 6%. That means no matter what happens, you will earn 6%. Government is not going to run away with your money. You'll get 6%. But since you invest in the market, you have a risk. That is why you charge a premium. That is why your expectancy is high. That's what we're doing. I'll explain. See, RM refers to market return. RM minus RF is market risk premium. It represents extra return that we would have earned in the market, but we haven't invested in the market. We have invested in the stock. Therefore, beta into RM minus RF, this is known as security risk premium. See, I'll explain it in very simple terms. See, RF is risk-free return that you could have earned by investing in government securities, but instead you invested in the market. So you'll earn an extra return. This is called market risk premium. Since you are taking a risk, You will obviously, this is 6%, so this has to be 10%, greater than 6%, obviously. For example, this is 10%. So this 4% is your market risk premium. Premium for taking a risk. Instead of investing in risk free, you are taking a risky position. This is called market risk premium. That is what you would have earned had you invested in the market. But you aren't investing in the market, you are investing in an individual stock. An individual stock's relation with market is captured through beta. So market risk premium multiplied by beta will give you security risk premium. This is what we have done. So we will earn when what is our expectation? RE is required rate of return. What does a shareholder or an investor expect to earn when he invests money in your company? Basic, he wants RF. He would have earned that in government securities. In addition to that, he needs to earn a premium based on the risk that your stock has. So risk of that your stock has into market premium will be equal to the premium that you should earn on this stock plus RF equal to RE. Very easy to understand. Also, if RF is not directly given in the question, how to calculate? Coupon amount divided by market price. This will be of government securities. So if market price is 100, coupon amount is 10. You are earning 10% return, 10 rupees return on 100 rupees. So that is 10%. And since it is government security, so this is RF, risk-free return. You'll always calculate annualized yield, right? RF is in annual terms. What is RE? RE refers to the required rate of return. See, we could earn RF by investing in government securities, but we invested in a stock. So we expect a higher rate of return as a reward for taking the risk. Obviously, that's what I told you. Risk is captured through beta and additional return is equal to RM minus RF. So beta into RM minus RF is the extra return for investing in this stock. And RF you'll earn. So RF plus beta into RM minus RF is our required rate of return, right? Very easy. Just a sec. So if beta is 2 and market return is 10%, what does that mean? We will get 20% return. We want to get 20% return. First statement is wrong. There is no guarantee. Who's guaranteeing you will get a 20% return? We want to get a 20% return. RE is required rate of return. What we want to earn. What is our basic intention? Our goal while we investing, right? And we are taking double the risk as compared to the market, therefore we need double return. See, beta 2 into 10, 20%. See, beta of 2 means that if market moves by 1, our stock will move by 2. So we have double the risk as compared to the market. So if market gives you 10%, we need 20% to compensate for that additional risk. That is why we are asking for a double return. Okay. No, we are making an investment decision and hence RE is calculated. Obviously, why are we doing all this? We are doing all this since we need to evaluate whether we need to invest or not. See, if we want to earn 20% return and a stock can give us only 15% return, we won't invest in that. But how to make this comparison? How to get that figure of 20? That is why we calculate RE. Okay. And since we discussed multiple times about beta, what is beta? Beta captures the relationship between market and stock. Okay, we already know that. For a 1% change in market, how much will the stock change by? If beta is greater than 1, it means an aggressive stock, high volatility. Obviously, like beta greater than 1 means that market moves by 1, beta will your stock will move by 1.5, a beta 1.5. So that is more risky, more volatile. High volatile, it is called an aggressive stock. Beta less than 1, defensive stock, low volatility. Market moves by 1, your stock moves only by 0.5, a defensive stock, low volatility. Pharmaceutical stock, something like that. Okay. Beta of government securities is 0. Why? Since there is no risk. Beta captures the risk, right? And there is no risk. These are risk-free securities. So government securities beta is 0, and beta of market portfolio is always 1. Relation of market with market will be 1. If market moves by 1%, market will move by 1%. Obviously, that's what it says, right? And take a 0 and 1. We have learned that. How do we calculate beta? We have understood what is beta. Now how do we calculate it? We have 4 formulas. Okay, first is percentage change in stock return upon percentage change in market return. So instead of beta directly given, they could give you that the stock changes by 5% if the market changes by 10%. So that means a beta of 0.55 upon 10, right? The second formula is covariance between stock and the market divided by variance of market. See, M stands for market. Covariance of X comma M whole divided by variance of market. Look at it. Think about it. You'll understand what's happening here. You are calculating covariance, deviation. if you remember. So covariance between the stock and the market divided by the variance of market will give you the relation between stock and market, and that is beta. That's what exactly what we're doing, right? And the third way can be r x comma m into sigma x upon sigma m. What is this? R, correlation between stock and market multiplied by risk of stock upon risk of market. So we'll get beta. What is the correlation? Possibility of them moving similarly multiplied by risk of individual stock and the market. So that will, the product will give you beta. How much will the stock change if market changes, right? Simple, very easy. Don't just learn, read and understand. If you are facing problems, then just pause the video once. I obviously cannot get into too many details because this is intended to be a revision video. If I upload a 4-hour long revision video, you won't be able to, you wouldn't watch it on the day of the exam, right? We are trying to understand everything, but there are some things that you may take more time than I do. So just pause the video, think about it, and then move on. Okay. There's a fourth formula with a slope one figure. We won't be using that. That is not to be studied since it is time consuming and complex, and sums can be solved using the covariance formula. We've just discussed covariance between stock and market divided by variance of market. Okay. And don't worry, I guarantee I have solved every sum. They both use the same terms and everything, so you can solve every sum using covariance formula. So you don't need to use the slope formula. Completely ignore and forget that. Okay, it will cost you time and effort and may not give you the correct answer because it is easy to make a mistake in the exam, right? And a few other points that we need to discuss. Can beta be negative? Yes. So if a stock is a beta of -2, that means if market increases by 1, stock falls by 2. If market falls by 1, stock increases by 2. Very good stock, useful for hedging. You can hedge your portfolio using this. That is, stock moves in the opposite direction as compared to the market. Other thing related to beta can be levered and unlevered beta, although it shouldn't be covered in this chapter, but since we are discussing beta in detail, I decided to pick it up here. Okay, beta levered is equal to beta unlevered into 1 plus d upon e, debt equity ratio, and since debt is always post tax, that's why 1 minus d. What is happening here? See, levered has debt and equity both, therefore it has a greater risk and higher beta. Unlevered has only equity, but beta has debt and equity both. So 1 plus debt upon equity. We are including the effect of that to get to levered from unlevered. Okay. And since debt is always post-tax, that's why debt is 1 minus t multiplied by 1 minus t. And levered has debt and equity both, so it has a greater risk, obviously, and therefore a higher beta. See, if you beta levered will always be greater than beta unlevered. 1 plus this, beta unlevered into 1 plus 1 point anything you'll multiply, you'll get a greater figure. Obviously, you can see these things, simple. And this will therefore always be higher, a higher beta. Beta of x into Rm will give you return of the stock. Why? See, Rm stands for return from the market, and if you multiply it by the beta of the stock, you'll get the return of the stock. If beta is 2, market gives 10%, you'll get 20% return from the stock. Simple. Beta square x into sigma square m, variance of market, will give you systematic risk. We discussed that already. Beta squared into variance of market will give you systematic risk. So beta into return will return of stock, beta into variance, systematic risk. Okay. And beta of portfolio is the weighted average beta of individual stocks. Like you have 1, 2, 3, 4, 5, whatever betas of individual stocks, you'll calculate a weighted average. Weights, you already know their proportion of investment. So if we have 2 lakhs investment in stock X and the portfolio value is 5 lakhs, so it will have a 40% weight. So beta into 40%, beta of X into 40%, and then beta of Y into that, beta of Z into that respective weights, and the sum total of that will give you the weighted average beta of the portfolio. Okay. Weighted average beta of stocks will give you the beta of the portfolio, right? Okay. And return of portfolio equal to RF plus beta of portfolio into RM minus RF. Why did we calculate beta of the portfolio? So that we could calculate return from the portfolio. What we had studied was RE equal to RF plus beta into RM minus RF. Beta was of individual stock. Now since we are calculating return for the portfolio, we need beta for the portfolio. All other figures will remain the same. That's how we do it. Okay. How do we calculate systematic risk of the portfolio? Beta square into variance of market. Same, just beta is of the portfolio instead of stock. Earlier we had beta square x, right? and unsystematic risk equal to weight square into unsystematic risk of each stock. So first we'll calculate unsystematic risk of stock A, sigma square E. We'll calculate unsystematic risk of stock B, sigma square B E, right, and multiply by the respective weights to get unsystematic risk of the portfolio. Very easy. So we have a formula for this, we have weighted average for this, and return of the portfolio, right? And sorry, MPT, modern portfolio theory, holds good here too. Why? See, the risk gets reduced. What does MPT say? When you combine stocks in a portfolio, overall risk gets reduced. So the risk gets reduced here too. What risk gets reduced? Unsystematic risk gets reduced. Obviously you cannot remove systematic risk. So when we say that portfolio leads to risk reduction, it refers to risk reduction in terms of unsystematic risk. That's what falls down. Okay, and we have other formulas for covariance too. See, the original formula is average of joint deviation of x around x bar and y around y bar. Okay, and other formula can be r into sigma x into sigma y. If you look closely, this isn't something that you need to learn. Why? Because r, how do we calculate r? Covariance xy upon sigma x sigma y. If you cross multiply, you get covariance. So if you have r given and sigma x given, sigma y given, so you multiply all of them and you can get covariance between x and y. Very easy. Or beta x into beta y into variance of market. What are we calculating? Covariance, variance of the two towards the market, right? So variance of the market multiplied by individual betas, that will give you covariance. Very easy. And obviously remember the original formula, x around x bar, y minus y around y bar, joint deviation average, right? And now we have a few more topics. That one of them is SML, security market line. RE equal to RF plus RM minus RF into beta, the formula we have already learnt. Something similar to this is CML, capital market line. RE equal to RF plus RM minus RF into sigma x upon sigma m. What are we doing? Standard deviation of stock upon standard deviation of market. SML uses beta and captures only systematic risk. Obviously, beta captures a systematic risk, but this captures a total risk, risk of the stock upon risk of the market, right? And this is used ratio of SD and captures total risk. And if you look closely, they are, both of them are almost same. CML is standard deviation of stock upon standard deviation of market, right? And SML is beta of stock upon beta of market. But we only wrote beta. Why didn't we write this here? Because beta of market is always 1. So it is done in a hidden manner. Beta of stock is 2, beta of market is 1. It will be 2. So that's why only beta of stock is visible in this formula. Okay, both are same. The method of solving things is same. Now we have one more thing, characteristic line. What is this? See, there are a huge number of stocks in the market. It is not possible to find out correlation between all of them. Like obviously, if you want to make an investment, you cannot calculate, like you invest in Reliance, you cannot calculate Reliance and TCS, Reliance and Tata Motors, Reliance and Hindustan Unilever. You'll go crazy doing all this. So you cannot, it is not possible to find out correlation between all of them. Therefore, we find out the relation between individual stock and the market. Obviously, this relation is depicted through characteristic line. Beta, points of the line, captures the systematic risk. Unsystematic risk is captured by error points, points not falling on the line. Remember, I told you we'll discuss it later in characteristic line. We are here. R is closer to 1 means more points closer to line, and characteristic line is unique for every stock. Okay. And see, this is a return of the stock, return of the market, beta. Beta captures the relation, market return to stock return. Okay. And all the points falling on this line are beta, systematic risk. The points falling outside this line, these are the error terms that we were talking about. So this captures the unsystematic risk. This entire thing is total risk. This is systematic risk. These are unsystematic risk. Okay. And this is okay, R closer to 1. So we have R closer to 1. That means more and more points are closer to line. That is stocks. The stock is more likely to move as similar as compared to the market. The stock is more likely to move similarly as compared to the market. Okay, and the lower the R is, the more scattered these points are. R refers, what is R? R is correlation, tendency of points to fall in a straight line. So greater R means greater tendency to fall in a straight line, that is greater likelihood of forming a line. Lower R means lower tendency of falling in a line. Scattered points, no correlation, random movements here and there. Okay. And we have one more thing, coefficient of determination. I'll advise you to write every single one of them because you can get confused. Covariance. coefficient of determination, coefficient of variation, variance, all of these are similar terms, right? Correlation, R. Coefficient of determination is R square, that is equal to systematic risk upon total risk. R square equal to systematic risk upon total risk. How does this hold true? We'll understand right now. See, it shows the strength or reliability of beta, how strong your beta is. Greater, let us now just think about it, what I'm about to say. Greater R, if R is greater, this means that more points will be closer to line, right? And this means that there will be a low number of error terms, more points closer to line, less scattered points, low number of error terms. Low number of error terms means low unsystematic risk. Low unsystematic risk means greater proportion of systematic risk in total risk. Obviously, if unsystematic risk is falling, so the proportion of SR and TR will increase, obviously, and that means a greater coefficient of determination, SR upon TR. So if R increases, SR upon TR increases. So obviously bigger R means bigger R square. So this side will increase if R increases, and this side will also increase if R increases. You're able to understand, right? R, if R is 2, R square is 4. If R is 3, R square is 9. Obviously R can be less than 1, I know that. But I was just giving an example. So as we move, R increases, R this side also increases since proportion of SR and TR increases. This is the logic behind this formula. This is how we reach here. And this is why this holds good. Coefficient of determination R square equal to SR upon TR. Remember that, okay? Fundamentally strong companies will always have a high SR and low UR. Obviously, they are more likely to perform as per the market, and they don't have individual factors scattering their movement, right? And for example, Reliance, TCS, Infosys, okay? So now you need to think. Normally we want R to be lower so that there is greater risk reduction. However, here we said that greater R means fundamentally strong company. So R should be less or R should be more? See, when we discuss R should be lower, that was discussed in terms of a portfolio. The lower the R is, the greater risk reduction is there. But here we are talking about an individual company. So for an individual company, greater R with the market refers to a fundamentally strong company. R in the portfolio was between individual stocks, stock A versus stock B. Here we are talking in terms of stock A versus the market. That is why greater R will mean a fundamentally strong company. Okay, this is how you need to understand things. So now we have, how do we evaluate portfolio returns? We have Sharpe ratio, Trenner ratio, Jensen's alpha. Okay, what is Sharpe ratio? Rx minus Rf upon sigma x, that is extra return earned per unit of risk. Okay, risk free is the base return, how much you are earning for taking this risk. You are taking a risk by investing in X, so you need to earn a higher return as compared to Rf has zero risk, so the extra return divided by the risk taken. Sharpe ratio. Trenner ratio, extra return per unit of systematic risk, that captures total risk, this captures beta x, that is systematic risk. Just a sec. Sorry. So this captures only systematic risk, that captures total risk. Higher is better, obviously, greater return per unit of risk. So the higher the ratio is, the better it is for us. Sharpe ratio and Trenner ratio both should be as high as possible. Okay. Jensen's alpha, actual return minus CAPM return. CAPM return, R equal to RF plus beta into RM minus RF, right? So actual return minus CAPM return is called Jensen's alpha. Positive alpha means that you have performed better than the market, obviously. Like if it is 20 and it is 15, so we have 5%, 5. Positive means you have performed better than the market. Negative means you have performed poorer than the market. Zero alpha means you have performed exactly like the market. 15 is your return, 15 is what CAPM earns. So you're performing in tandem with the market, right? Okay, so next topic is arbitrage pricing theory. We have completed MPT, we have completed CAPM, right? And now we have arbitrage pricing theory, APT. It is very similar to CAPM. It is just a variation of CAPM. It is a multi-factor model. It is a variation of CAPM. It says that Sensex or Nifty do not denote all risky assets. That is the logic behind creation of this. So it breaks down systematic risk into multiple parts like inflation, GDP, interest rate, forex fluctuation, etc. Okay, so systematic risk is beta. It breaks down, like beta captures the relation between stock and the index market, Nifty Sensex, right? But APT says that index does not denote all risky assets. So we split the beta into individual risky assets like inflation, GDP, interest rate, forex fluctuation. Risk premium as well as beta of each factor is different, obviously. Like risk premium, we had market risk premium, what we earned in the extra in the market, RM minus RF, and beta of each factor is different, obviously, how they react to their individual scenarios. And risk premium refers to actual return minus risk free return. We have learned that. This is also called factor risk premium, and ICI uses lambda to denote this in their sums. So what is happening? See, RE equal to RF plus beta into RM minus RF. This is CAPM. In APT, we'll have multiple things. We'll have RE equal to first RF plus beta 1 into RM minus RF. Instead of RM, we'll have the first factor's return. Okay. Then plus RF plus beta 2 into return 2 minus RF. We'll add all of them. The formula is just the same. Instead of the original formula, we have individual betas and individual returns. So we'll calculate the sum total to get to RE. It is very easy and very simple to solve, right? If you're confused and don't understand, if you see the symbol lambda in the questions, your mind should run in this direction, that the ICI is asking a question related to APT, arbitrage pricing theory. Okay, so we have completed 3 topics. Now we have the 4th topic, portfolio revision or rebalancing. See, in this we assume that the portfolio is made up of stocks and bonds. Bonds give a fixed return, you know what bonds are, right? And so there are 3 strategies. One is buy and hold, do nothing. You bought stocks 2 years back and bonds 2 years back, and now you're waiting. You sell them after 10 years or whatever. So buy and hold, very easy, you can understand from the name itself. Second is constant mix. Focus is to maintain the same proportion between shares and the bonds. So for example, you have 60% shares and 40% bonds. So if the value of equity increases due to profit, obviously, a part of the profits is reinvested in bonds to bring it back to earlier proportion. So for example, you have 60 and 40. You earn profit in the shares. So proportion of shares will increase in the portfolio because their value increases. So you'll reinvest a part of the profit so that the ratio is again 60 is to 40. Okay. So for example, earlier the value of the portfolio was 1 lakh and you had 60,000 and 40,000. If it increases to 1.5 lakh, you'll have 60% and 40%, 90,000 and 60,000 then in shares and bonds. You'll maintain the same proportion, constant mix, as the name suggests. Okay, very easy to solve. Amount invested in equity is called aggressive portfolio. Amount invested in bonds is called defensive portfolio or conservative portfolio. And the profits reinvested in bonds to bring it back to the earlier proportion. This entire process is called rebalancing. Portfolio rebalancing and revision, that's what we are studying. First was buy and hold, second is constant mix, same ratio maintained. Okay. Now we have third, CPPI, constant proportion insurance policy, variation of rebalancing. Investor decides a floor value below which the portfolio should not fall. Like my portfolio value is 1 lakh. I decide that my portfolio value should not fall below 80,000 or not fall below 50,000, whatever happens. Okay. So such amount should be invested in government securities. Obviously, since there's no risk, we want a basic bare minimum to remain, like our base capital. We don't want our entire capital to get eroded due to the market. So we want to secure a part of our investment. So that is why we'll invest that in government securities or treasury bills. Okay. And this is invested in non-fluctuating assets. So we have no risk. Target investment in equity will be equal to portfolio value minus floor value. This should be the target value, right? So for example, if you have a goal, like I have a portfolio of 1 lakh and I do not want it to fall below 40,000. So 1 lakh minus 40,000, 60,000 should be the amount to be invested in equity. But we won't invest 60,000. We'll invest more than 60,000. Why? Since share price does not become zero. Share price never becomes zero. You cannot get a straight loss like today Reliance is 2000, tomorrow it will be zero. That is not possible. That is why we have a position of we have a situation where we can leverage our amount. Leverage means same investment, additional risk, additional exposure. Okay, that's what we are doing, and that is captured through M, multiplier. So if question gives a multiplier of 1.5, so 60,000 into 1.5, 90,000 is the amount of equity that we can buy. Multiplier will always be greater than 1. Obviously it is used to give leverage, and share price does not become zero. Therefore amount to be invested in bonds will be portfolio value minus equity. So 1 lakh minus 90,000, 10,000 is what you need to invest in bonds. So first of all, you calculated the amount floor value. That is what you need to invest in government securities. That is what should not, your portfolio value should not fall below this. But since you are in a position to gain leverage, you invest additional amount. Like 1 lakh minus 40,000, 60,000 should be invested in equity, but you are investing 90,000 and only 10,000 in bonds. Okay. and that's how you calculate this. And question will give us RF, risk-free rate of return. What use is that? It will be useful while calculating the value of bonds and also while calculating the floor value. So time value of money, discounting, compounding, obviously no need to explain that. Remember, investment in bonds is not equal to floor value. You need to remember that floor value was 40,000, but in the end investment in bonds was 1 lakh minus 90,000, only 10,000. Okay, and this is because of leverage effect due to multiplier. You can solve a sum if you want, but it is very highly unlikely that this will come in exam. Okay. Next topic is efficient market hypothesis. We have three types of markets: strong, semi-strong, weak. Weak market where technical analysis is irrelevant. Semi-strong where even fundamental is irrelevant. So technical plus fundamental. And in strong markets, technical, fundamental and insider information all are irrelevant. Okay. There's nothing to explain in this, you just need to learn. We need to perform a runs test. What is a runs test? See, plus minus stock prices keep on moving, variation is there, fluctuating, someday it will rise, someday it will fall, obviously. And if there is a continuous plus, it means a run. If there is a continuous minus, it means a run. Okay. And R refers to the number of runs. You'll be given a data of 20 days. For example, Nifty price at the day 1 will be given, day 2, day 3, day 4 till day 20. You'll be required to calculate whether it has increased or fallen. So you'll keep on writing plus minus. Then you'll identify how many patterns are there. Like if you have 2 or more plus in a row or 2 or more minus in a row, that counts as a run. So you'll calculate the total number of runs, that will be denoted by R. Number of plus will be denoted by N1, number of minus will be denoted by N2. So out of 20, let us suppose 12 days market has gone up, 8 days market has gone down. So N1 equal to 12, N2 equal to 8. Okay. You'll be required to calculate the mean. There's a formula, you need to learn it. 2N1 N2 upon N1 plus N2, the whole thing plus 1. Nothing to explain, you just have to learn it. I am explaining what you need to do. Okay. And then you will be required to calculate the standard deviation. U minus 1, U minus 2. U means mean here. We are calculating mean upon N1 plus N2 minus 1. Simple formula, you have to learn it. See, what is this? What is the logic behind all this? See, if there are very less runs, like for example, out of 20 entries, 10 days it has gone plus, 10 days it has gone minus. This means that it is a predictable market and arbitrage is possible. Obviously, now you can see that 10 days it follows the same trend. So there is a predictability in the market. You can make returns. You can make arbitrage profit. Okay. And if there are too many runs, plus minus plus, there too much volatility, means predictable market. See, this is too much stability, this is too much volatility. Both ways you can make arbitrage profit if you already know how the market is going to perform. That is why you need to evaluate all of this. And in a good market, runs should be random. Okay, obviously only then market will function smoothly and nobody will be able to misuse it. We come to the last topic, that is Sharpe's optimal portfolio. This formula is used to identify stocks to be included in the portfolio. How to evaluate and identify stocks, which stocks are the best to suit our portfolio. See, you need to follow the following steps. First is find out the excess return to beta for each stock. We've already studied this Trenner ratio, RX minus RF upon beta. That refers to the extra return earned as compared to risk-free securities by investing in this stock. So that is Trenner ratio. We already studied that. Trenner ratio captures systematic risk. Sharpe ratio captures total risk, right? So instead of beta, it has sigma x in the denominator. Rank the stocks from highest to lowest. You calculated the ratio. Now, as per this ratio, rank them highest to lowest. Okay. And calculate C for all the stocks in order of ranks. There's a tiring, boring formula. You need to read that. Read from the book because there's nothing to explain. That is why I'm not discussing this in detail. Institute never asked this question too, right? And on the last day, you need to focus on those topics that are more likely to be asked and are more important. That is why, and this is intended to be a last day revision video. So that is why I've ignored the C formula. The highest value of C shall be denoted at C star. See, you calculated Trenner ratio for every one of them, then you rank them descending order, higher to lower. Okay, then you'll calculate C for every stock. Now when you calculate C, one of them C's value of C will be the highest. So for example, 1 to 6, you have 6 stocks, you've arranged them in descending order, and stock number 3 has the highest value of C. So you'll denote it as C star. Okay, stock number 3. and it will be used as the cutoff point. Stocks with trainer ratio below this will be rejected. So 4, 5 and 6 will be rejected. Okay. Securities having trainer ratio higher than C star will become a part of the optimum portfolio. So security 1 and 2 will be included in a portfolio. After selection of the securities, weights. Now you've decided which stocks you need to include in a portfolio, stock 1 and stock 2. Now how much should I invest in stock 1, how much should I invest in stock 2? The Z formula tells you that. I have not written the formula, you need to read it from your book. Okay. And it shows weights. We need to calculate weights. What are weights? Proportion of investment. Simple. Okay. So now we have completed all the concepts. You need to solve important questions. You must have marked questions, or if you haven't, then mark them now. Go through your book, solve questions on a calculator, and the ones where you make a mistake or you're able to recall or you're unable to recall the concept or the topic, mark them and use them for last day revision. And why do we need to write and solve? Because there is a lot of scope for clerical mistakes. See, obviously I have discussed all the concepts, I have tried to explain the logic behind all the formulas, but at the end of the day you need to remember the logic as well as the actual formula itself. There is an element of learning involved in this chapter, like you can learn the concepts in all the chapters, but in this chapter you need to get into rote learning, because the formula is what matters. Understanding formula is one thing, applying it is another thing, and you need to do both. Don't just learn the formulas, remember the concepts, remember the logics that I've explained. That is how you will be able to solve questions, because the question will give you a huge long paragraph and you'll have to figure out things yourself. So if your mind is moving in the right direction, your concepts are clear, you'll be able to link everything and solve them in the right direction and in the right order and get the right answer. Okay. And if the question confuses you, use A, B, X, Y, whatever you are comfortable with. Like question will have weird names, but we need to calculate Rx, Ry, sigma X, sigma Y, whatever. So you need to denote terms as per your comfort zone. Okay. As much as you stay in your comfort zone, the more you stay in your comfort zone, the more you will perform better. Remember that. And if you are stuck, then you need to solve whatever you can. So let us suppose you're in the exam and you look at a question and you don't know what to do, you are unable to recall anything. There are a few things that you can start solving. You can calculate the probability, the mean, the variance, SD, covariance. You remember the formulas, right? So just start solving, solve whatever you can. You'll get into the flow and you'll be able to slowly recall things one by one, and then you'll be able to solve. This will be your starting point. That's why I've told you this. Okay. Thank you very much for watching the video. My name is Abhinav Sekhri and I can be contacted. You can WhatsApp me at 96494 And this was the first time that I've recorded a video in English. So if anyone faced any problems or didn't like the way I explained things, I'm very sorry about that. I'll try to improve it in the further videos, and do give your feedback. Feedback is welcome, and stay safe and don't focus on the negativity around you. There's a lot going on, I understand that, but you need to rise above it, and don't give a break in your studies. No matter what happens, whether the exams are held on time or they aren't held on time, you need to maintain consistency. That will help you, trust me. Okay, good luck, all the best.